I really want to talk about today is the I want to talk about these papers that are published. And as I said, I mentioned this, and I think this is kind of a big deal. And I know you're probably thinking, I've mentioned this in the daily videos, right? You're probably thinking, oh boy, I can't wait to talk about papers. How exciting. Well, this is exciting. If you're actually trading, this is exciting because there are several nuggets hidden here. And what I hope you get from this, by the end of this session, I hope you will understand how we use the tools. Other thing that I want you to understand is maybe come away with some ideas for thinking about trading problems in general. That's kind of the hidden subtext here. There are ways that you might already be doing or might be doing to think about market movements. I want to walk you through. If you understand the logic for why we evaluate things like we do, it's going to point you toward profitable trading. And just take a little bit of time to understand. Just so you know where to find these resources library, there are currently two papers. So this applies primarily to stock traders. Why does it not apply to futures traders? Well, it does, but in a different way. So if you're a stock trader, you get these stock scans, and the pullback buy options just tells you that these scans are run on a smaller universe of optionable stocks. So if you go into one of these options scans, what you're going to find is, of course, we can't guarantee they're all going to be super liquid, but you're going to be able to make these trades with options if you prefer to. Some of these other scans don't rely on options, and it's a much bigger universe, but there's some smaller stocks there. So you have the raw scan that we're talking about here. So I say in the paper that we started publishing these in September of 2017. In all honesty, the way the scan was created was I had a number of pieces of trading systems and scans that I had been running for myself for years, things that I'd used both for my trading, for day trading, stocks, currencies, futures. And so, there's a clue. We're looking at stock scans here, but these actually, these algorithms came from multi-asset approaches and multi-time frames. But this was something that I never shared with anybody. So always kept this kind of close to the vest. And when Tom and I started Market Life, I said, uh, we need to have, I want to be able to give people general pullback conditions. We also had a little bit of an issue, which is the raw output from these is not super impressive. So I'm just going to drop through here. This is what's on a typical pullback scan. Just look at these. I'm just going to kind of throw out some comments on these. Uh, these were valid last night. Okay, that's a decent pullback. We took a bit of a hit trading that damn thing, but still a good pullback. CrowdStrike. Okay, so that ended up working. That's gone today. That's a decent pullback. I don't know that I'd be really excited about trading that stock. Look at all the gaps. So, that's probably, and it's also kind of a weird pattern. I wouldn't really look at that. Uh, so okay, here's actually a good issue. This is a pullback, and what the pullback algorithm does, which is not very clearly articulated in the paper, looks for the market to make a big move and then make a pullback, right? And we've quantified the big move in a few ways and the pullback in a few ways, and these are really crude algorithms. They're not like super finely tuned. This is one reason why they continue to work so well, but they have kind of a short vision. So when this scan is telling you this is a good pullback, what it's looking at is something in this zone. It does have the ability to look further back, but it's really most interested in what's happening right there. Now, one of the things that I will do from a discretionary standpoint is I'll put it in context, and I'll do that. You see, I've just zoomed out the daily, which is fine, or you can look at the weekly. But if you look at those are very similar charts at this point, right? At least they tell you the same story. And I'm aware that this is not, structurally what this stock is doing. Is I see that we came out of a trading range, and then of course I'm not going to define these things super carefully. We dropped into another trading range, and I'm placing a trade just kind of in the middle of the range. Now, what I'm looking for is looking for a 1 hour trade, which I certainly could have gotten there if I'd been buying somewhere in this pullback. But the whole point of this ramble is this is an example of the kind of pattern that is not exciting to me contextually, so I would pass on this. We could, of course, have built context into the scans, but then it becomes a very complicated scan. I can easily write this on a cocktail napkin in a bar and give you the existing algorithm rules. I guess it's a little redundant, right? Um, but said so, we didn't want something that was very complex. What I expect to do is to get these raw inputs and then do some visual filtering. I don't like the way that pulled back. That's probably a decent pullback, but similar to the point that I made in the with I was doing some one-on-one training here, and I pointed out, I also talked about this in the daily videos, so you didn't miss anything, that we thought we were going to be looking for long trades here in crude oil, even though context is maybe not great for that. But then the next bar shows us, no, you're not, right? That's not. So, sometimes people, one of the questions we get is, okay, so you talk about a reluctant pullback. What is a reluctant pullback? And well, I'll tell you, it's not that. Right. That's definitely not what we're looking for. So this we then go through, and obviously that's not a pullback that I'm going to be trading. I go through this as kind of raw material. That's maybe an interesting pullback today, and that's part of my daily homework, is to go through these pullback scans. That's what's behind the algorithm, and that's the history. In terms of data, we made the decision to only test these things on the S&P, sometimes the S&P cash, sometimes the futures. And this is one of the questions we have for today, comes from the Discord, and this is a good question. I'm wondering about the claim that a signal which is intended for broad use and that does not show an edge in the S&P 500 index is likely not a good signal. He asks, why is that the case? It makes intuitive sense, and while I understand the overlap between broad use and the S&P, there's still a difference. There's still differences between individual stocks and the S&P as a whole. Absolutely. If the S&P test is meant to be a sample of the strategy, why not do tests with a number of the actually recommended stocks? Because it's more complicated, right? I mean, you're asking what I think is one of the critical questions. There are a lot of ways we could do this. We could look at the stocks we actually published. We could look at the stocks that we actually were in the tradable universe. We could do a random selection of the tradable universe carried forward at some point in time. There are a lot of things we can do here, but yeah, in my old age, I guess I'm thinking, if I give you this great trading signal and you go trade it on the daily chart of the S&P for 10 years and you don't make money, I think you should be justified in thinking maybe it's not such a great signal, Adam. This is just a simple, crude way to do the test. The idea of making this accessible and approachable is also really important. It's also good when you're looking at any set of raw data. You just want to know a little bit, and you probably actually should know a lot more about the raw data, like how many bars are in it. In particular, this baseline return is going to be important. And when we're looking at small signals, small amounts, we many times talk about basis points, and that's 100th of a percent. Here is the rough explanation of the algorithm, which I explained a little bit here. Um, let's look down to the evaluation, and let's go to this picture first. So what this shows is, also with doing the test on the S&P, we have a manageable number of signals. We have here, over the course of these 10 years, not 10-ish years, 68 signals. So what this means is we could go in and examine the nuance and the detail of each one of those. Now, I think that would be probably a mistake because we would be thinking things were significant that were not actually significant. But it lets us do a graph like this. And what I've done here is this is the number of days from signal generation. Now, the first 10 are calculated day to day. It doesn't actually get smoother. There's just fewer data points. And so I think there are a few things you can take away from here. First of all, remember what you're looking at. What you're looking at is a signal that will trigger, like in here, right? Are you buying this market here? No, I don't think so. Just look through all of these. Like some of these you might be decent to buy, but the vast majority of these are things that are not set up for actual buys. This pattern would be in that data set. And that's not great, right? Because no like thinking trader would ever execute on patterns like that. It's going to be patterns like that. So this is, again, this is not a nuanced signal. This is a very, very rough signal. And if you just closed your eyes and bought any random day, you get the red line. So the red line is basically your buy and hold return. That is what you need to compare everything else to. What you notice here is with these pullback signals, the majority of them do cluster above the line. And if you go out here, just for reference, the middle of the chart's 1 month, and the right edge of the chart is 2 months from the time it triggers. Now, again, I want to be super clear. This doesn't mean that we went long underway or we saw patterns that went long underway. This just means from the time the thing made the most basic pullback. This is a really crude tool. I cannot overemphasize that. I remember where I was before. Where I got sidetracked before was saying that the thing that made me decide I could safely publish was the more data I looked at, the more I saw that the patterns that I was using, primarily pullbacks and similar structures, existed in all markets that I had data on. So I went back and I looked at stocks from the 60s. I looked at stocks before and between the world wars. I looked at stocks before. Now, as you go back, data gets kind of spooky. I looked at stocks before 1900 and I saw the same pullback patterns. So I believe that what we're queuing into here are really core fundamental aspects of how financial markets behave. I don't know why. I think I have some ideas about why, but what I can tell you is that this appears to be a super enduring edge. I just want to point out that this is pretty good data. I also want, and you need to be prepared. I want to call your attention to volatility. Please look. I don't know if you can see my mouse very well. Look at the left hand side of the. So these are losers, right? These are stocks that we, or not stocks, but they're setups and spots where we might have wanted to buy. And some of these 5 days later got hit really, really hard. So you do need to be prepared for a good deal of volatility. Let's look at the same graph for the sells. Now, this is interesting, right? So, first of all, anytime you see a handful of big winners, so these are shorts, so down are winners, you want to be aware that these are going to have your entire edge might be explained by these few outliers. What I mean by that is, and this is not a negative, you just need to know this is the way trading can work. You certainly can have, in fact, this is the way trading usually does work. Let's say you get to the end of end of a month and you made 20 trades. What you're likely to find is that all of your profit comes from one or two trades. And then the other 18-ish trades kind of netted out. maybe as a small win or a small loss. It's not going to be exactly zero, but much of your performance depends on a few trades. Now, that is, as we have pushed things more to focusing on our targets, that becomes much less of an issue. But and this is, this is one way to get away from that and that reliance, because the problem with this is trend followers were, and I believe this approach is not viable anymore, but they were kind of the ultimate expression of this, that if you missed one trade, you could destroy your whole year. So, you might do 100 trades throughout the year, and literally all your profits come from one trade. And you might even have really good performance. You might make 30% a year on average, and it's still all due to one or two trades. So you got to get all those trades. So just be aware there are some outliers. It's really, really hard, and I bemoan this a bit in the paper. It's really hard to find good short signals for stocks, and this is one. But even with it being one, you need to realize that a lot of it's not nearly as good as the long signal, and a lot of statistically valid short signals for stocks still lose money. You're scratching your head, right? Because how could that be? So the way it is stocks go up on average 70% a year, and I can have a statistically valid short signal where stocks only go up 2% a year. However, what I say, they go up, right? It's less than 8, but if I'm short those stocks, I will lose money. So this is one reason why people don't some people don't trade shorts. In this particular case, the bold line here is kind of the juice in the signals. And what you see is these pullback sells do have quite a bit of juice. A week later, you're down on average 73 basis points. It's almost a percent. That's a lot, right? Uh, 2 weeks, it's a little bit less. And this is not a gigantic sample size deliberately. However, the edge appears to disappear further out. In fact, it becomes positive because maybe mean reversion actually kicks in. This is a significance test, and some of these are zeros to like 14 decimal places. So that's a non-parametric. If you're curious, you probably know what that is. If you don't care, you don't care. The other interesting way to evaluate this is the probability of a stock closing up. So any day, one day later, you're up 54% of the time. And if you have this pullback sell condition, it's only 48. That's a pretty big difference. It's not statistically significant, but it's a pretty big difference. You go out 3 days, you're at 58% of the time versus only 48 when you have the signal. So, but then you go out to a month, 20 trading days. This is trading days, by the way. And you're looking at a difference that's not really very much. Let's go up and look at the table for the buys a little bit. Um, the buys here have, so these numbers are not as big, but they are more consistent. And yes, these fail significance tests, but that's okay. That's a separate discussion here. They don't fail out here. So the buys appear to be a little bit persistent, and we see that reflected in the chart, right? Like, you know, it gets a little bit spooky there for the shorts, and it looks pretty good there for the longs. We also have here one of the real edges is there's a fairly hefty edge to stocks closing up. 4 days later, you're up 75% of the time versus should only be 60% of the time. Now, that doesn't seem like a home run, and it's not a home run. There are no home runs, but it's a pretty big difference. And the buy condition also, uh, when you have the buy condition, you're higher 88% of the time. Don't bet the farm. It's not 100%, but it's a pretty good signal. One of the other characteristics here is that the signals are clustered. So these are the buy signals. And if you were trading this and this was the only thing you were doing, you'd have whole years where you didn't do shit, right? There's the buy signals. Here's the sell signal. The axis is a little bit different. These do actually kind of come clustered. in different spots for the most part, but you would expect that. But you're still looking at a lot of clustering, right? And many periods where you don't have a trade. So that's how I think about the paper. Let's talk about the table here because you're going to be seeing these tables, and these tables appear in other aspects of my work. So what we're looking at here is the top. Actually, let's look at the bottom. Look at the. I guess it's really the middle, but what I've highlighted here. This is the baseline. This is the unconditional return. This is the buy and hold return, and you can see the characteristics here. Um, this is the average is the percent return. There's also a median, which I, don't get too sidetracked by that. And then what you're looking at against that is the average of the signal. So what this is saying is of the 68 signals, 2 days later, you were up 16 basis points, and it's only 8 basis points in the baseline, and then this number gives you the difference, and this gives you significance. So there are a lot of numbers there, and I kind of went back and forth between just giving a simple visual presentation, but I thought for the people who really want to understand it, there is a little bit of nuance. Like one of the things that I might be curious about is I might want to know the standard deviation. It's not, in this case, is not exactly a measure of volatility, but look here, 5 days on the buy signal, the standard deviation is 174 versus 211 of the baseline. So this is actually a little bit more stable. And then what I would expect with the sell signal is I would expect the sell signal to be more volatile, and it is. And knowing things like that helps me shape my expectations for this. This is not for me, this is not just a specific trading tool. This is a lens through which I see the market, and it helps me understand how the market moves. If you have questions, type them. I'm going to look at the MSI paper